I'm John Amodio. I'm chairman of SCORE of Staten Island. I want to welcome all of you on behalf of the Richmond County Savings Bank to this webinar that we have today called All Encompassing 2020 Federal Tax Highlights. We're putting this on in collaboration with Doreen and Sarah, CPA, and also with the Independent Association of Accountants of Staten Island. We're doing this so that the people who are interested in getting some CPE or CE credits, they can get such. We are at SCORE, we are mentors to small business. At the present time, because of this coronavirus, we're only doing mentoring by phone, email, telephone, or virtual workshops like this. This webinar is going to be recorded, and we will be posting it to our website and under the subcaption of libraries. We're going to put it into SCORE Staten Island's library so that if you want to look at it later on, you can. And if you think you want somebody else to look at it, you can get them to look at it as well. At this point in time, I want to turn it over to Leonard Andis. And Leonard, would you please?
Good morning, everyone. My name is Leonard Andis. I am the president of the Independent Association of Accountants. I'd like to welcome everyone to our webinar today, the All-Encompassing Federal Tax Highlights for 2020. And as we all know, there are plenty of them, and I'm sure more to come. I also want to take this opportunity to thank several people for all the work and help they provided during the year. John Amodio, Marie Gracie, I hope I got that right. John, your whole staff over there, for your assistance that you provided during the year, because without you guys, we probably wouldn't have been able to get to the point that we did. I'd also like to thank Doreen. Doreen has done a considerable amount of work for the IAA this year, including most of our presentations. So Doreen, a very big thank you for everything you put in for the year and being able to get the credits and everything. We had tried to attach the slides. Unfortunately, it didn't work. So we're going to forward them as we have been in the past after the meeting. As John mentioned, there's also going to be a recording available for future reference. If you notice on the screen right now, you'll see a couple of points. Your lines are going to be muted. Please use the Q&A versus the chat. As I said, copy of the slides will be sent. You'll also be receiving surveys afterwards, either from SCORE or from myself if you're applying for credits. Okay, those surveys have to be completed. They must include the 5 keywords that we're going to be given during the meeting. Okay, they'll be given periodically. Please write them down, as I really am not supposed to repeat them or given to you after the fact. In addition to which, please make sure you sign the evaluations, because they're not good without a signature. In signing them, an electronic signature will be acceptable. Okay, so if you can do it that way, you can. If not, you have to kind of scan them out and scan them back in. I'll forward certificates for your records once I get back all the evaluations, or at least the majority of them. There'll be a 5-minute break around the 1 hour point. I'm going to give you this, and I think I'm going to post it in the chat, and it's also at the end of the presentation. If anybody wants to get in touch with me for the IAA, my email is liaranger, RANGER, @AOL.com, and I can also be reached at 718-948-3008. It's also, as I said, at the end of Doreen's presentation. We'll do questions and answers. We'll try and fit some in as we go along. It's not always easy. We will do a Q&A at the end, and if it permits, we might run a little bit over with the Q&A, okay, if that's agreeable to everybody. We'll make sure, though, that we get all the keywords and everything in so people can get their credit if they have to go off at approximately 11:30, 11:35 or so. The last thing I want to mention is for IAA members, or people who go to our meetings, but of course it's open to anybody that would like to. We have 3 more seminars going for the rest of the year. We have one on December 22nd dealing with ethics. Okay, this will be in the afternoon from 12 to 2. So you can have lunch while you enjoy your ethical procedures for the year and get your 2 credits. Richard Rothkamp, okay, I'm sure some of you are familiar with him, some aren't. He'll be doing that presentation. I'm very happy to say that on January 21st, Juan Bergstein and Jack Gold will be back for the umpteenth year doing our annual update. That will be from 7 to 9:30 that night. Okay, it might run a little bit longer, depending on how long we run it, will be whether it will be a 2 or 3 credit seminar. And then we have another possible one, which is going to be set up like, I think the second or third day of February. Okay, and it's going to be on family limited partnerships, and Matthew Rappaport is going to be doing that. We haven't finalized the details on the date and time. So if anybody'd like more info on those, if you're on our mailing list, you will get the emails. If you're not, get me your info and we'd be happy to add you. With that, I'm not going to take any more time. I'm going to forward this over to Doreen and let her go because I know she has a lot of great information for us. Doreen,
Yes, thank you. Thank you, John. Thank you, Lenny. We are going to go back, way back into time, and we're going to go from 2017 to 2020. So we have a lot to cover. We'll try to keep the Q&A, Lenny, to the end if possible, but if there's something pressing, we will definitely cover it.
okay.
I'm going to start
If I get in
currently.
at any point and you want to push it to the end, just let me know. That's all.
Okay. We're going to start, of course, with 2020 and us all dealing with the pandemic. And we're familiar with the CARES Act, of course, of 2020. And a lot of the CARES Act affects the Tax Cuts and Jobs Act. So we will bring those intercessions in with this presentation where applicable. The CARES Act, as we all know, was signed into law March 27th of 2020. It was a $2.2 trillion act. And the first thing we dealt with was the economic impact payments. Of course, pandemic unemployment, and then we had our SBA various loans. We're going to cover all that and our favorite topic of PPP loan forgiveness later on. So let's start with the economic impact payments. And the reason why I bring this up is because on your 2020 tax returns, you're going to deal with the recovery rebate. It's not going to be taxable, but you need to be aware how it is calculated. It is going to be based on either your 2000 or 2018 or 2019 tax returns, not on the 2020. So when this payment, this economic impact payment came about, which was for individuals, $1,200, depending on the AGI, and we'll talk about that, and $2,400 for married filing joint, the eligible individuals cannot include, as you see on this slide, non-resident aliens, individuals who may be claimed as a dependent on another person's return, estates, or trusts. And of course, you saw a lot of promotion about signing up for the economic impact payment by November 21st for those individuals that had dependents and may not need to file. They will be able to get that economic impact payment through a recovery rebate by filing during 2020. But their qualifying child must match the qualifying dependent definition, which I also highlighted here on the presentation. It's a child, a stepchild, eligible foster child, brother, sister, stepbrother, or stepsister, or a descendant of any of them, sorry. And also, they've had to live in the home of the taxpayer more than half the year, and that taxpayer had to provide more than half the support. So that's the economic impact payment, and this is the threshold. I provided you a chart just to remind you about the filing status and where the AGI was offered for them to get the full payment. That would be under 75,000 and under for single and married filing separately. They would be able to receive the $1,200. For head of household, it would have been 112,500 and under, and married filing joint for the 25,400 joint would be $150,000. As you phased up to that top threshold, the economic impact payment would be reduced. And when you're doing the 2020 tax returns, you're not going to have the ability to use the 2020 income. It's going to be just based on the 18 and 19. But what I want to emphasize here is that when you receive the economic impact payment, subsequently, you should have received, or your client should have received, a notice 1444. That would have the amount of the economic impact payment on it. They need that for tax season, because as tax practitioners also on the call and on this Zoom, you will need to use that notice to enter that information in the recovery rebate credit section of the return. Otherwise, I've been told by the stakeholder liaison that those returns could be stalled. So we either have to try to use the Get My Payment tool to see if we could find out some information. I don't think that the amount is going to be there, and we need the notice, and the taxpayers need to be aware of what they did receive, as well as for ourselves. Now, on the bottom of this presentation, which I want you to see, I'm going to move my slides here, is that the IRS mailed a special letter to 9 million non-filers, urging them to claim this economic impact payment. So if they didn't, they can then file on their 2020. They're going to be required to file a 2020 tax return, and we'll talk about how, later on, some of the other forms that for non-filers that will need to file also. A significant question that I received during this time was whether a deceased taxpayer received that payment, was received for that deceased taxpayer, what would happen? Does someone who has died qualify for the payment? And this was put out May 6th of 2020. A payment made to someone who died before receipt of the payment, that payment must be returned. And so that was a question that we were unsure about. So I wanted to make sure that if there's any of these cases that you are returning those payments, or your client's family are returning those payments. However, if it's a married filing joint return, the surviving spouse can keep the $1,200 additional payment. And I provide the procedures here in this handout on what the client or the taxpayer would need to do to return those payments. Originally, they were coming in check form, then they came in those debit card form, but there is a process where you need to return either the debit card or the check in a voided fashion back to the IRS. And I provide you the various addresses based on the location of where the deceased lived. In addition, if it has to do with a foreign taxpayer from a foreign country, US possession or territory, they would then use this address, which is the Austin, Texas address of the Internal Revenue Service, APO or FPO address, and also file form 2555 or 4563 for dual status aliens. All right, so there is a process for that. The rest of the CARES Act, we're going to go through each section. This part of the presentation is a summary of what we're going to cover. So let's get right into it. One of the first provisions of the CARES Act is the charitable contributions. And this is something that the IRS has been promoting all along. They want you to be aware that there is an above the line $300 charitable contribution, sort of like the teacher's deduction for $250, but it cannot be used by taxpayers who itemize their deductions, right? They will not get that additional benefit. In addition, it must be donated to publicly supported charities, which you could find at irs.gov under publication 78 for those qualified charities. And it cannot go to a non-operating foundation or a donor advised funds. So you want to make sure that you have a few days left of December that you take advantage of this charitable above the line contribution. In addition, for corporations, the CARES Act temporarily increases the limitation on the deductibility of cash. And in most of these provisions, it's cash, non-cash, not non-cash, charitable contributions during 2020 from 10% to 25%. So that's for your corporations of the taxpayers, the corporation's taxable income. And it also increases the limitation on deductions for contributions of food inventory from 15% to 25% for corporations. And for individuals, the CARES Act Section 2205 temporarily suspends the AGI limitation for qualifying cash contributions. Currently, it's 60% of your adjusted gross income. Now it's based on 100% of adjusted gross income just for 2020. So where is it not 100%? I always like to look at and be the devil's advocate. Where is it not where we could get that 100%? And the 100% charitable contribution deduction doesn't apply to donations of stock and real estate or items that have a long-term capital gain segment of it type property. It is still subject to 30% of AGI limitation, regardless of the recipient. Now, if you do make a contribution and it's more than the limitation, you didn't realize that it wasn't the 100% limitation, you will get a carryover and it does go for 5 years. So that's not a problem. All right, that's our charitable contributions. The second has to do with the relief available for students, or what is known as student forbearance. And that covers the federal student loan payments are suspended. Interest rate is temporarily set to 0% on federal student loans, and student loans in default are no longer subject to IRS garnishment. That has been extended to January 31st, 2021. In addition, they're still available, as we always had, tax-free student loan benefits that an employer can give an employee up to $5,250 of student loans. And that may be repaid by an employer tax-free as part of a qualifying education assistance program. In addition to student loan repayments, qualifying educational assistance. And it's just not limited to direct payments of tuition fees, book supplies, and equipment, okay? But it has to be for the employee, not for the employee's child or the employee's spouse. It's different than the forbearance. The deadline is December 31st, 2020, okay? So that's still available for employers and also to help pay down student loans. But if that is under that tax-free assistance, the student loan interest in that case cannot be deductible. And again, this slide just shows you that the forbearance has been extended to January 31st, 2021. In addition, under the CARES Act, as many of us know, we had the suspension of required minimum distributions. This includes RMDs required for the 2020 tax year. The waiver also includes RMDs that are due by April 1st, 2021, because the account owner turned 70 and a half in 2019. And that's under the CARES Act, Section 2203. Where possible, I try to provide you the citation. Now, in this case, the taxpayer does not have to prove that they were affected by the pandemic, okay, by COVID-19. Where they do is this next slide, which is the coronavirus related relief, CRD distribution. It's either for a simple SEP or your traditional IRAs, your retirement plans at work as well, if the employer has decided to participate. What it does, of course, the most important thing is that if the employee or the taxpayer who's taking this distribution is under age 59 and a half, they will not be subject to the 10% early withdrawal penalty. A lot of confusion with this because there is income tax, and so you need to do planning with this. It is divided over 3 years, and on the third year, the recipient could decide to return that distribution, and it's up to $100,000 from qualified retirement plans. So when you're in the planning stage now before the end of the year, you want to make sure that January 15th for individuals, that you're determining whether there should be withholdings on these distributions, and to cover actually the 3 years, the current 2020, 21, and 22, so there could be carryover. The concern is that when the distribution comes in to the recipient, they may spend all the funds and may not have the funds later on to make payment on the third that of income that they will owe for the subsequent years. Now, the distribution must be to an individual or the spouse or dependent of an individual diagnosed with COVID-19, or in this case, they also show SARS-CoV-2, and it must be proved by the CDC approved test. So you'd have to prove that you're adhering to quarantine orders, being furloughed or laid off, having work hours reduced, being unable to work due to lack of child care, closing or reducing hours of a business owned or operated by the individual, and other factors that could be determined on a case-by-case basis. But the tip we want to bring here is that if a positive virus test result cannot be obtained, you have to encourage yourselves, your clients, those who have taken these distributions, to take extra care in substantiating their eligibility. They will have the burden of proof, the taxpayer, when this goes on their return. So how is this going to be reported? And what is the tax treatment? Any distributions considered CRD related are subject, as I said, to over a 3-year period, beginning in 2020. And within 3 years of receiving those distributions, taxpayers have the option to recontribute them on the third year. That would have been similar to what you would have done with a 60-day rollover, right? So you're allowed to roll it back in the third year. Well, what if you reported those distributions in the first, second, not in the third year because you decided to roll it back? You would have to then go back and amend 2020 tax return and 2021 when you have proof of the rollover. What you want to be concerned about is that this is subject to the one rollover per year provision. So if you're within those 12 months, and it doesn't have to be in a calendar year, it could be from when the first rollover occurred, 12 months after, you want to make sure you plan back the rollover, because it could be disqualified if you had another IRA rollover in that segment, okay? Now, trustee to trustee doesn't apply to that rule. It's when you actually receive the funds, like you would in this case. If you had done it previously within the year period and had to roll back in 60 days and you had this CRD, you wouldn't be able to choose the rollback. And if you have a rollback, I'm going to call it, you need to contribute. If you took cash, you need to return cash. If you took 50 shares of AT&T stock, you need to return the 50 shares of AT&T stock, despite the fact that maybe that it has gone down. So there are specific regs with regards to this, and we want to make sure that we're very careful in how.
Doreen,
Yes.
let me just interrupt for a second here.
Mhm.
Time for our first keyword. First
Okay.
keyword is stimulus. STIMULUS. I'm spelling them just in case anybody doesn't get the clarity in my saying them.
So
Please write it
stimulus is a
down.
very long word, stimulus.
Yeah, sorry about that.
This is all
Just
about
write 'em
economic
down.
stimulus.
Yes. Try to
Okay.
use relevant words. Okay,
Very
make
good,
sure
Lenny.
you write
Thank
them
you.
down. Also, just a reminder, you have to be on for 110 minutes of the presentation to get credit. We know one or two people have had some problem getting in, and we'll deal with that accordingly. All right, we're trying to fix it at the moment. All right,
Okay. So here's where we talk about whether or not you're required to file a federal income tax return. When you get these distributions, you're going to have to use Form 8915-E, which is expected to be available before the end of 2020 to report any repayment of what is known as coronavirus-related distributions. And that's in conjunction with Section 4 of Notice 2005-92. As you notice, it's 2005. So this type of activity has been around for a while. They're just going to update the form. 8915 is available currently, but you're not going to see the coronavirus distributions listed, those types of exceptions listed on that form as yet. How do the plans and IRAs report the CRDs? Well, the payment of a CRD to a qualified individual must be reported by that plan on a Form 1099-R, which is distributions from pensions, annuities, retirement, or profit-sharing plans, IRAs, insurance contracts, etc. Anything that's a type of deferred plan. It's required even if that individual repays the CRD. So you could see how this could get complicated. And we're supposed to get more information on it, but you could see Section 3 of Notice 2005-92 if you want to learn a little bit more about this type of subject. Now, the administrator of the plan, and I actually help someone prepare an application for this, can rely on the individual's written certification that he or she meets the conditions of what is listed as qualifications under the coronavirus-related distribution. And not all employer retirement plans are required to adopt it, okay? But I'm thinking most of them have. So what plan loan relief is provided under Section 2202 of the CARES Act? It permits an additional year also for a repayment of loans from eligible retirement plans. Now, this does not include your IRAs, and it relaxes limits on loans. And again, it's optional for the employer to adopt. So, for example, certain loan repayments may be delayed for 1 year. If a loan is outstanding on or after the March 27, 2020 date, which is when the law was signed in, and the repayment on the loan is due from that date to December 31st, that due date may be delayed under the plan for up to 1 year. Okay, again, this comes from Section 5.B of Notice 2005-92 from the IRS. And the loan limit has increased. We know it has gone up to that $100,000 mark. But what if you have other loans outstanding? The CARES Act also permits employers to increase that maximum loan amount. As we said, it used to be $50,000 and now went up to $100,000 for plan loans made to a qualified individual, but only up to September 22nd, 2020. So the limit may be increased up to the lesser of $100,000 minus any outstanding plan loans that the individual had, or to the individual's vested benefit under the plan. And again, you could go to Section 5A of Notice 2005-92 to find out more about that. So I'm going to go into my favorite subject now, after the coronavirus-related distributions, is net operating losses for our small businesses. This has been changed, and you need to pay careful attention about this. The first tip I'm going to give you is you must first determine if you have a net operating loss. And you can use IRS publication 536. They have worksheets to determine that in a particular year. But what happened here was that under the CARES Act, there is now an automatic carryback to 2018, 19, and for 2020, 5 years back. So starting March 27, 2020, for any returns that you filed after that date, you must put a statement for each of those years to decide if you're going to relinquish the carryback. That's that old section 172 that I'm deciding to not elect the carryback period, okay? Also, under the Tax Cuts and Jobs Act, and we said we were going to talk about that, of 2017, the limitations on net operating losses for married couples in 2018 was $500,000, and for single taxpayers, $250,000. Those were raised for the cost of inflation to $518,000 and $259,000, but were taken away under the CARES Act. So now it's 100%, right? It's not 80% of a number. We don't have a threshold, and the net operating losses could be used 100%. But the problem is, first we have to determine if they should be automatically carried back. And if we don't want that automatic carryback, we need to elect on a return filed after March 27, 2020, with a statement for each of those returns. So now you have to revisit back to your 2018, 2019 tax returns. And when you're doing your 2020s, the taxpayers may elect to relinquish the entire 5-year carryback period with respect to a net operating loss in that particular year. And of course, it's irrevocable once it's made, and it must be filed with a timely filed return. Now, there are temporary procedures that were put in place because what they wanted you to do with these NOLs is to get a quick refund for that business. They also wanted you to use not only net operating losses, but credits from alternative minimum tax that was provided in the Tax Cuts and Jobs Act for corporations not to be subject to AMT. So they accelerated now the refund of the AMT. And if you're revisiting your business or you're a practitioner on the Zoom and you're looking at your clients individually, there's a quick claim refund form of Form 1139. And for your businesses, Form 1045, okay? And that Section 2303 made several modifications to that net operating loss, as we said, for 18, 19, or 20. And if you are eligible for these carrybacks and you submit the forms, there is now a fax number that I have at the bottom of my slide. I'm going to move my picture there if it's blocking it, where you can fax 1139 and 1045. To the IRS. And that started April 17, 2020 to get a quick refund. All right, so the fax number for the 1139 is 844-249-6236. I have it bolded there. And then for the 1045 corporate returns, 844-249-6237. Please keep in mind, these numbers are not for general use. They're not for everything. You could just only fax those forms. Anything else you send to them, they're going to ignore. All right, so we can ask for quick refunds for net operating losses. We can ask for quick refunds on alternative minimum tax credit refund. The CARES Act allows the refundable AMT to be accelerated for the 2021 into the 21 year here. If you notice on this slide here, under the Tax Cuts and Jobs Act of 17, the credit was refundable over a series of years with a remainder recoverable in 2021. Now with the CARES Act, they expedited that and allows corporations to claim 100% of their alternative minimum tax credits that have been left over from 19 as fully refundable and provide an election to accelerate claims from 18 and 19 with this accelerated refund. And that's under CARES Act Section 2305. So you want to use those numbers because eventually what's going to happen, I believe, maybe they'll extend it past into January, but by December 31st, they may put those numbers, down, okay? So if I previously mailed in my form 1139 or form 1045, can I now fax it? Yes, the answer is you can fax those forms. They're requesting a maximum of 100 pages, but if you did mail it in, you can fax them. Just indicate that on the form that this is the faxed version. I'm getting some of the FAQs on this area from the IRS. So if you see an FAQ that's coming from the IRS, one of the questions was, may I use Form 1139, which is a quick claim refund for an individual that maybe has a business, Schedule C business on their return, or a Form 1045 for the corporation, as applicable to apply for refund for Section 965. What is Section 965? Section 965 requires U.S. shareholders, as defined under Section 951B, to pay a transition tax on the untaxed foreign earnings of certain specified foreign corporations, as if those earnings had been repatriated to the United States. And yes, you may disregard the instructions on Form 1139 and 1045, which prohibit taxpayers from using these forms to apply for refunds for 965 years. So I wanted you to be aware of that you can also get refunds from that area if that's applicable to you or your clients. When do I expect to get a refund from a Form 1139 or 1045 that was faxed under these temporary procedures? Well, similar to the PPP loans, the statutory time frame for processing these forms is 90 days. And of course, we know that the IRS has been affected by the pandemic due to a lot of their mail, offices being closed, and millions of mail just sitting in bins. They claim 90 days because they want to get these quick refunds here. And throughout this presentation, I provide you links. You'll be getting a handout so you could read more about it. Now, will the IRS be establishing a similar procedure for Form 4466, corporation application for quick refund of overpayment of estimated tax? No, the Form 4466 must be filed in accordance with existing form instructions. What is that for? We made estimates, and when we realize some of the applications of net operating losses or AMT credits will reduce the amount of estimates that we needed to pay, we can ask for an application of quick refund on Form 4466, but it cannot be faxed in, all right? And of course, these temporary faxing numbers will eventually be shut down. So that's your net operating loss and alternative minimum tax areas that you can get quick refunds on under the CARES Act. Under the CARES Act, we also talk about Section 163J, which is business interest expense. Now, most of us as small businesses will be exempted from the limitation, which under the Tax Cuts and Jobs Act was 30% of ATI, adjusted taxable income. And the reason why I bring this up, I was actually working on a trust that was flowing through to an individual tax return. And the client said, oh, I just, I invested in this publicly traded partnership. And, oh, I have all these K1s. And well, one of the K1s was going to New York City. And he had a $16,000 add back because of this business interest expense. Because you would say, well, I'm under the $25 million threshold, which is, you look back 3 years. If the business is under the $25 million threshold and gross receipts now 26 million, you're not subject to the limitation. So I don't have to worry about this. But if I'm an individual and I'm getting K1s, which are flowed through forms to report on our returns, and the partnership is adding back the business interest expense, you need to be aware of it. And of course, practitioners need to be aware of that. So this has been eased, and the limitation has gone from 30% to 50%. So we'll see a little bit reduction in add backs. What I threw in here was that some of the states and local levels are either a rolling or a fixed date conformity with these provisions. I brought up New York City. So states like Idaho, Indiana, Maine, Virginia, and West Virginia have already updated their provisions under the CARES Act. But other states, such as California, Connecticut, Georgia, Missouri, South Carolina, Tennessee, and Wisconsin, are starting to adopt. So you need to know where your state is. I'm going to talk a little bit about state issues with regards to New York. New York, at this point, I don't see the adoption of the CARES Act there. So you're going to be aware of that there may be, as we talk about later, for partnerships, you might see it in 2020 where they'll get the increase up to the 50%. They specifically were left of 2020, not 2019 and 2020. So you should be aware of that. Another great thing that happened in the CARES Act that affected the Tax Cuts and Jobs Act of 2017 is that we had this phrase called qualified improvement property. And if we run a business, there were three categories now: qualified leasehold improvement property, qualified restaurant property, and qualified retained improvement property. Okay, they now are all part of qualified improvement property. What happened under the Tax Cuts and Jobs Act, that it was listed as 39-year property. So it was subject to that life, which means we weren't able to take 100% bonus depreciation. Well, under the CARES Act, that was corrected. So now it specifically designates qualified improvement property, QIP, as 15-year property for general depreciation systems and for specifically designated to the alternate depreciation system, 20-year property, which is okay, because then we are eligible for bonus depreciation. But what happened? It's retroactive to 2018 and 2019. And so that means we now have to look at whether we should also, in this case, amend those returns to get the bonus depreciation, right? So on the bottom of the slide, I give you an alternative to amending, which is you may file an automatic Form 3115, which is an application for change in accounting method that can be with your 2019 returns, in your 2018 returns, to take advantage of the new favorable treatment and claim the missed depreciation as a favorable Section 48A adjustment. So that's an option that you can take, but you need to be aware of it. Also, taxpayers that placed QIP into service in 2019 can claim 100% bonus depreciation prospectively going forward on their 2019 return, and should consider whether they can file Form 4466, we talked about that earlier, to quickly recover overpayments of estimated taxes, right? So it's beneficial also for the corporations, because those prior years, the corporations were being taxed at a top tax rate of 35%. And then in 2018, it went to 21%. So it'd be great to get a quick refund using that as well. So when the pandemic hit, the US Senate issued the Small Business Owners Guide to the CARES Act. And so I gave you a link to that. It's very plain language. I also give you a link to the SBA Treasury site of updated FAQs, because we're going to talk about some of their loan programs. To keep up to date on these programs, I really want to thank SCORE for Staten Island for providing this important informational presentation every year. In the US Senate Guide, Small Business Owners Guide, they mention contact your local Small Business Administration district offices and your local SCORE chapter mentors. So I want to thank them for that, for doing this presentation. So let's go through some of the small business debt relief programs that the Small Business Administration offered during this pandemic. Now, they always had the program where they provided non-disaster SBA loans, in particular 7A and 504 micro loans, okay? But they did provide, as we know, the Paycheck Protection Program, or PPP loans. And this program was provided for cash flow assistance through 100% federally guaranteed loans to employers, okay? With safe harbor provisions that came out later in the Flexibility Act. And these were for businesses with 500 or fewer employees, okay? So we have two acts that went on with the Paycheck Protection Program. We have the CARES Act of 2020, and we have the PPP Flexibility Act of 2020. The PPP Flexibility Act came June 5th. The CARES Act started March 27th, all right? And it covers all of these small business type entities, sole proprietorships, independent contractors, self-employeds, 501c3 nonprofit organizations, 501c19 veterans organizations, or tribal businesses affected by COVID-19. What is most important though, this program would be retroactive to February 15, 2020. So it means the business had to be in business as of that date. And I provide you a link on that slide. What was immediately carved out was passive investors, okay, in real estate. So most broadly, businesses that primarily engaged in owning or purchasing real estate and leasing real estate for any purpose were not eligible for PPP. And I list at the bottom of the slide the following businesses that were specifically listed as ineligible. And that's your passive business developers, your passive landlords. What's passive? We've talked about this before. A minimum of 500 hours requires you to prove passive, non-passive activity, that you're an active real estate owner, right? That you're actively involved amongst other measures. And by the way, it doesn't include collecting the rent. So that's very interesting. Businesses engaged in subdividing real estate. Businesses that lease land for cell phone towers are immediately carved out. Businesses that enter into a management agreement with a third party that give the management company sole discretion to manage the operation, such as apartment buildings. These are carved out and ineligible for the PPP. Real estate management and other service companies are eligible because more than likely they have payroll. So the PPP, how did we determine the loan amount originally when we went to the bank that was backed by the Small Business Administration? Well, for self-employeds and sole proprietors, your independent contractors, they had to submit their Schedule C, line 31, from their 2019 Form 1040. And essentially, if they use those funds during the covered period for their owner compensation, then they would have most likely have qualified themselves for forgiveness once they have to submit that application in, as long as they didn't have other payroll in there. For your partnerships, the partnership itself had to apply for the PPP, okay? But they used the partner's Schedule K1 line 14A, which is part of the partnership return for self-employment income, to determine the PPP loan amount. And in both these cases, they would take those amounts, they would divide them by 12 to get the monthly amount, times 2.5. And that would be your PPP loan amount. And of course, if there was no other employees, you had a small, closely held business, and they used it during the covered period, which is from the date you received the disbursement to the date the covered period ends. And we have two acts going on here. So I might have been a business who took a PPP loan before June 5th. That means I have an 8-week period to spend those funds. Or I might be under the PPP Flexibility Act, which started June 5th and goes to December 31st, 2020. Now, you can talk to your lender as a small business and say, listen, I want to be covered under the Flexibility Act, which is a longer period of time, and more than likely they would adapt to that. But what I want to emphasize here, and I do in the middle of the slide, is that, look, if you had 1099ers, you are not getting PPP for them. They have to apply for their own PPP, okay? And in addition, there's another burden that we're required this year for 2020. There's what's called the 1099 NEC, NEC. And that works in conjunction with your 1099 miscellaneous now. What happens is this is non-employee compensation. It's a specific form. It has its own form. It must go out by January 31st, 2021 for 2020. It must go to the recipient. It must go to the IRS, and there's going to be matching. So you need to make sure that you're cognizant of the compliance of these forms, and they cannot go on extension. All the other 1099 miscellaneous will cover the other categories that are normal on a regular 1099, such as paying rent to your landlord or paying a lawyer legal fees. Those are still on the form 1099 miscellaneous, okay? So as part of the PPP loan program, if we applied for PPP loan and we're a small business, we're going through this pandemic, there's other incentives that we had. We had what was called the employer retention tax credit, which is a dollar for dollar credit. You can't take that credit if you have gotten the PPP loan. Okay, so you're not eligible for the employer retention credit. We'll talk a little bit about that. And I provide you a link to a calculator to determine forgiveness, okay? So we will go over that. How does PPP loan forgiveness work? How does PPP loan forgiveness work? Because we're in the period now of either helping our clients or our own businesses are submitting applications for forgiveness. Now, there are 3 forms. There's a 3508S, which is a more simple form. It's a standard form, they call it a simple form. 3508EZ, which ups it up a little bit of a notch, talking about your FTEs and so on. And then you have your 3508, full-fledged, okay? For the 3508S, that's for loans 50,000 and under. And about 2/3 of the businesses took loans in that area. So that's what you're going to be dealing with. And essentially, like I said, if you're a sole proprietor and you submitted your 2019 business schedule C from your form 1040, and they calculated your loan forgiveness amount and you paid yourself owner's compensation, you give them the canceled checks and your bank statements, you proved you made the payments, you're fine. Same thing with the partnerships. It gets a little tricky when you have employees, okay? Because then we have to determine, did you spend 60% of the funds on payroll, which is part of the Flexibility Act and which most businesses are going to be targeting for, and 40% for other, or did you spend 100% on payroll, which is okay, all right? And if you did spend only 60% on payroll and 40% on the other qualified expenses, did you make sure that these qualified expenses, such as mortgage obligations, rent, and utilities, were in place from February 15, 2020, and then weren't paid outside the covered period? Because then you will not be eligible for forgiveness on the whole amount. So what specific components of payroll? Because remember, this is a program to keep payroll going. So it's for any compensation to US-based employees, including salaries, wages, commissions, or familiar compensation, cash tips, or the equivalent, okay? Watch out for the subchapter S 2% shareholder with regards to their health insurance, because there's certain limitations there with adding back group health care coverage, okay, when you're calculating these amounts. Generally, the banks are going to ask you for your 941s, and if you're a New York State employer, your New York State 45s, which is your payroll quarterlies. They're even asking those for sole proprietorships, because the banks don't really understand the difference between Schedule C owner compensation or partners guaranteed payments versus a 941 and NYS 45. So you're going to have to email and give them explanations on this as well, because they're responsible for collecting that information. And remember, salaries cannot be more than 100,000 that were part of this calculation. Of course, the bank is going to make sure of that. And when you're filling these forms, especially the 3508EZ, you could not have decreased salaries and wages by more than 25% for any employee who made less than $100,000 in 2019. And of course, they use the qualified period in 2019 for the benchmark when calculating on the 3508EZ and the 3508. Now, the bottom question on this slide is, can I pay my loan off earlier than 2 years? And yes, there are no prepayment penalties. Now it's 5 years under the Flexibility Act. That was under the CARES Act.
Doreen,
So,
I'm
yes.
going to interrupt with another word.
Okay,
The next word is waiver, waiver, waiver. Also, Doreen, got a few
yes,
minutes to go, so wherever you want to stop and take a break, we're about
okay.
that time.
We'll go a few more slides and then I'll let you know when we're ready to
Okay,
stop.
and I have a couple of questions if you want to deal with them just before or after the break.
All right, right before the break, we'll take care of that because we have a lot to
Okay.
go.
Again, the
All right.
word was waiver.
The word is waiver. So we're going to ask for a waiver. Okay, remember the word is waiver. So how do I apply for loan forgiveness? Again, we're going to look at payroll. We're going to look at owner compensation. We're going to look at partnership guaranteed payments. We're going to also look at full-time equivalents. Now, that's based on a 40-hour work week, if your loan was based on that. And the full-time employee will get a score of 1 and the part-time will get a 0.5. And you'll go back to that 2019 period to do your comparison and then look at the covered period and see if you decreased. If there was a decrease and it wasn't part of the safe harbor, then you will get a reduction in your loan forgiveness. If you decreased wages or average hourly pay by more than 25%, you're going to get a reduction in the forgiveness. I mean, that's just how simple it is. But in all these documents, you must certify that the documents are true and that you use the forgiveness amount to keep employees on your payroll or yourself on your own compensation and make eligible mortgage, interest, rent, and utility payments as well, if that's part of the calculation. And the bank must make a decision on the forgiveness within 60 days of receiving that application. Okay, and then SBA actually has 90 days. I actually provide you a flow chart at the end. We don't have a lot of time here, so we can't go through all the details, but I wanted to give you the most important highlights. Now, under the CARES Act, the PPP loan could have a maximum maturity of 10 years, but under the Small Business Administration, they subsequently assign a maturity date of 2 years and then 5 years under PPP flexibility. So it looks like we have a 5-year period, okay, to pay this back. And now, most importantly, if you look at the bottom of this slide, the PPP Flexibility Act extends the deferral period. So in order to apply for the loan to the date the lender receives the forgiven amount from SBA, you have 10 months following the end of the covered period. Now, let's say you were under the Flexibility Act starting subsequent to June 5th. Let's say you went in August. Well, that period of time, the 168 days under flexibility that you're to use the funds will pass December 31st. You can't go past December 31st. So you're going to need to use those funds. Your small business is going to need to use the funds in order to get the forgiveness with using the correct criteria. But you do have 10 months following the end of the covered period. So you don't need to submit your applications now, your forgiveness application. I'm getting calls from all small business. I got to do it now. I got to do it before December 31st. No, you don't need to do that. We'll talk a little bit more about that. So under the CARES Act, as we said, a business could be eligible to receive a PPP loan and must use the funds during their covered period, okay, which now goes to December 31st, 2020. The original act was the CARES Act. You had 24 weeks and now 168 days. You have now 24 weeks. Previously to that, you had 8 weeks. So previously 8 weeks prior to June 5th, then 24 weeks past June 5th, which is 168 days. And of course, we talked about the 60% and the 40%, and also the fact that they're going to look at full-time equivalents where this is applicable. This new safe harbor, also in the Flexibility Act, provides that a reduction in the number of full-time equivalent employees will be disregarded if the borrower is able to document an inability to rehire individuals who were employees on February 15, 2020. So they have to document that and, not or, and an inability to hire similarly qualified employees for unfilled positions on or before December 31st, 2020. Okay? So they must document this activity, and also the fact that they would have to document if they were affected by government orders. For example, from the CDC or Centers for Disease Control and Prevention, or local orders that they had to deal with their state or locality. So I want to, if you don't remember anything else, please remember that all borrowers must retain their documentation for 6 years, okay? They must retain the documentation. Don't think because you file a 3508S and I'm under that $50,000 mark, I don't have to worry about anything else. They can ask for information later on. A borrower may now continue to defer 2020 payroll taxes even after it receives loan forgiveness. Before, I said you couldn't take retention credits, but you can defer payroll taxes. So we're going to go on to that. Payroll tax deferrals include employer payroll tax deferrals, include employee payroll tax deferrals. This slide talks about employers are allowed to defer. And that came about right away, March 27, 2020, and the Form 941s were revised for that, okay? The deferral must be paid back 50% by December 31st, 2021, if it's an employer Social Security tax deferral, and then 50% on December 31st, 2022. Okay, so that's your employer, and you still can have PPP. You also could have requested an economic injury disaster loan or grant. The grant was very confusing in the beginning because we thought we were getting $10,000 one shot, and that was a grant. No, it was actually $1,000 per employee. So if you had 10 employees, you did receive $10,000. But what you need to be aware of, if you did receive PPP funds, you can't use EIDL and PPP for the same expenses, right? You can't use them for the same expenses. And when the small business who was injured, they would have to prove injury with the EIDL, could refinance into the PPP, which is at a lower rate. EIDL's 4%, PPP was at 1%. I suggested to my small businesses who were involved with those two programs that they look into that. And also, I had some businesses who, they went to someone else to do their EIDL. We were doing PPP. They all of a sudden appears in their bank account something from the SBA from EIDL, and I'm like, you're not an injured business. You're an essential business. Why do you have these funds? Oh, I thought we were allowed to get it. No, you have to return them. Why? Because if they're not necessary, the SBA can penalize you at 1.5 times the balance. All right, so give them back. Give them back. And in the interim, the EIDL, they had an express loan of $25,000 while you were waiting. There was also help for contracting, government contractors, and there was a lot of agencies, as I said, the SCORE chapters who were helping mentor as we did during the pandemic.
Right.
So with that, Lenny, I will stop because then we'll do the Families First Coronavirus Response Act. That's a
Okay, I was just going to say that.
Okay.
Let's do these 3 questions quickly.
Yeah.
One, Patrick's asking, are these NOL rules going to be recognized by New York State, in your opinion?
No, I'm not. I'm not going to. I'm going to defer on a complete answer on that since this is a federal presentation. I'll get him more specific information on that. But it looks like to me, no, they're not adopting that. And New York State has their own NOL provisions, right, and add backs. So that's a whole separate presentation. But what I'll do for him is I will send him an email specifically offline. How's that?
Okay, Patrick, as you heard, she'll address you personally on that. Laura asked if you could clarify if a joint return was filed in 2019, but one spouse was deceased and the stimulus check was received for $2,400, does the $1,200 for the deceased spouse have to be returned?
No, it does not. As long as there's a surviving spouse, you're okay.
Okay. I wanted to add to the returning of the money that Doreen mentioned previously. I have noticed a little confusion over the year on that issue. But as far as I know, what Doreen said, the money has to be returned if there is no surviving spouse. Okay.
That's correct.
What they're going to do if you don't return it, Nobody knows, but legally, you're supposed to return the money.
Well, the only thing I could say here is that on the 2020 returns, and remember, it's linked to social security numbers, there's a recovery rebate credit line. And so that might affect the taxpayer. If they don't file, they're going to get a letter. And if they have to file a return, it's going to affect the filing of the return and probably could hold it up.
Okay, and then I
All
had
right.
one more question before we break.
ahead.
Hi, Cynthia had asked, if a business person with a single 401k wants to take a distribution under the CARES Act of 50,000, must they first adjust their 401k document to allow for the distribution before taking it?
That's correct. They would have had to amend their 401k document to participate in that.
Okay.
And they would work with their financial institution, and if they have a TPA, they would also work with them.
Okay, hopefully we've answered those questions. If anybody else has a question, please submit them through the Q&A. We'll take them up during the second half or after the presentation. Let's take a 5-minute break. On my clock, it's about 10:38.
Can you see the entire presentation slide, or are the gallery clips covering it?
No, I'm good.
You could see it.
I can see it.
Perfect. Okay, just want to make sure.
I got 2 more questions on what you just finished, if you want to address them to start. And then I will give a third keyword and then you can continue. Okay. The first question from Alexander, can you discuss the deductibility of payroll and rent expenses under the PPP rules?
Oh, we're going to go through that.
Oh, it's
It's
coming
going to be a
up?
whole
Okay.
section, yeah.
Okay,
I
and,
have a few slides, not a whole, obviously we have limited time, but we're going to go.
all right, so we'll discuss that coming up.
Yes, good question.
And then the other one, does the employer have any responsibility when it comes to issuing the 100,000 from the employee's pension plan? Does the deferred compensation plan qualify for not having to pay the 10% penalty?
Deferred compensation plans, like from a governmental employer, it would have had to adopt the plan. It's based on a per agency basis. I've talked to some of my clients who've had those plans, and they have gotten offers to participate in the CRD. They also had 2020 RMD suspended, but those would be specific letters to those agencies.
So it depends on the individual plan, you're saying?
Correct, because plans don't have to adopt it.
Okay, and they would have to request it if the plan
Correct.
documents didn't provide any
They
kind of.
would provide them the application for it, which would look like a safe harbor hardship application. May not specifically talk about COVID because they may not have had the time, but when you're filing your return is when you're going to have to report on that 8915-E, the exceptions.
Okay,
And
Tony,
how
I
you-
want to ask one question regarding this. Do you know on the 1099-Rs, have they made the adjustment that they are going to show a specific code for COVID-related withdrawals?
No, we talked about that. There's just going to be a 1099-R. My opinion is that even though you're under age 59 and a half and you took this distribution, the financial institution's not going to know. They're going to put in a code 1, and then you're going to have that form 8915 where you're going to have to, and the 5329 probably, where you're going to have to ask for the exception. So all these forms are going to have to be completed with the tax return to get the
Okay.
exception.
And you think they'll make any amendment on the, what was it, the 5329 or the 89 form?
Yeah, they're working on them now.
Okay,
Definitely the 8915. By the way, going back to Patrick's question, New York decouples. New York decouples from rolling conformity with the IRC and the CARES Act. So it looks like they decoupled from the CARES Act provisions.
West New York.
Yeah.
Okay, all right, everybody's back, hopefully. The third word, being that you said my words were long previously, I'm gonna be very short this time. It's actually gonna be initials. PPP. for
My
paycheck-
favorite acronym, PPP.
PPP. All right,
Easy to remember. Paycheck Protection Program.
you got it.
Okay, here we go, because we
Go
have,
ahead, 'cause we got a lot to pack into the
we got a
last.
lot, we have a lot of information here, and I want to get it to them. So, in addition to the CARES Act, we had on March 18th, previous to the CARES Act, which was March 27th, the Families First Coronavirus Response Act, FFCRA. And the first part of that act was for emergency family and medical leave expansion, what is known as EFMLEA. And that addresses those individuals that had hardships with the shutdowns, okay? They were unable to work, they weren't able to telecommute because their child was under the age of 18 due to the elementary or secondary school closures, or the daycares were closed. And after the first 10 days of leave, which can be unpaid, the employer must provide up to an additional 10 weeks of expanded family and medical leave. Okay, so that was immediately put into place to help those individuals that were getting affected by the shutdown. Employees. The required paid leave was calculated based on a regular pay rate for the number of hours the employee would normally work during a 10-week period, but not more than $200 per day and $10,000 in total. Okay, and you're going to see $10,000 limitation a lot throughout the CARES Act and related types of acts during this pandemic. Okay, so let's get to the next slide. And here we go. All right, so that was the first part of the FFCRA. The second part requires private employers with fewer than 500 employees to provide 80 hours of paid sick leave, as we see here. And that threshold was $511 per day and a total of $5,110 per employee. And they would have to prove that the employee was subject to a federal, state, or local quarantine or isolation order, advised by a healthcare provider to self-quarantine, or experience COVID-19 symptoms. Employees caring for an individual under the first and second acts, as we said, must receive 60% of their regular pay, and in this case, up to $2,000. And there are certain exemptions for employers with fewer than 50 employees. But New York State has a paid family leave policy already. So the employer should have a plan in place for that, so they really wouldn't have been exempted. They would have to use that program. So these small business provisions created tax provisions for the employer where they were able to get an employee retention credit, dollar for dollar credit. And the credit is provided for wages and compensation, including health benefits. And again, watch out for that 2% shareholder. And is provided for the first $10,000 in wages and compensation paid by the employer to an eligible employee. Now, wages do not include those taken into account for purposes of the payroll credit for required paid sick leave or paid family leave that we just previously talked about. So that's separate from this. This is under IRC section 45S. And of course, as I said earlier, the credit is not available to employers receiving assistance through the PPP, one of our words. The credit is provided through December 31st, 2020. And again, it goes through those provisions of quarantining and shutdown orders, government orders, CDC orders, etc. Okay, now, in conjunction with these credits, there is the Form 7200. And I'm going to provide to you, subsequent to this, a slide that goes over some of the errors that are happening with these 7200 forms. What's happening with the 7200 forms is they're monthly, or they could be sent in as often as needed to claim the credit, okay? It's an advance payment of employer credits due to COVID-19. All right, and these completed forms on the bottom of the slide should be faxed to 855-248-0552 for expediting that form, okay? So under this act, and with regards to those forms that we talked about in the previous parts 1 and 2, the Department of Labor is requiring employers to post information regarding the FFCRA to their employees during the pandemic, and also to be emailing them for those who telecommute, all right? So that's required. So now, let's talk about what type of compensation we're talking about is for the small business owner with fewer than 500 employees, and are also allowed to give terminated employees access to the sick and childcare leave benefits in certain situations. We're not going to have time to go through all that, but we're going to go through the retention credit. All right, so let's go through the employee retention credit. So as we said, the credit is available to employers, including nonprofits, whose operations have been fully or partially suspended as a result of the government orders, all right? Limiting commerce, limiting travel, limiting group meetings, right? And is provided to employers who have experienced a greater than 50% reduction in quarterly receipts, measured over that year-over-year basis, all right? Now, you're going to have wages of employees who are furloughed or face reduced hours in this calculation. Wages do not include those taken into account for the purposes of the payroll credits for paid sick leave or required paid family leave when calculating the employee retention credit. But this credit is provided for wages and compensation, including health benefits, and is provided for the first $10,000 in wages and compensation paid by the employer to an eligible employee, and is available, as we said, up to December 31st, 2020. So what happens when they take these credits? Plain language, they get a dollar for dollar credit. The tax credits are incredibly valuable, of course. So if you have a $10,000 tax liability on your payroll tax quarterly and a $3,000 tax credit from the retention credit, it's going to come off dollar for dollar. And the credit is calculated per employee and is 50% up to $10,000 in qualified wages paid per quarter. Okay? And that's going to be done there on the 941. But it works in conjunction with the 7200 form, advance payment of employer credits due to COVID-19, which alerts the IRS about the credits. And again, you need to fax those in. The requirements for the employee retention credit, ERTC, is either a forced closing of the business due to a government action or a significant drop in gross earnings. So it's an or situation, defined as 50% or more, okay? And it's not available to employers who have more than 100 employees. So what are the common errors that are being found on the form 7200 and when they're claiming these credits? And this was released by the IRS November 18th of 2020. Employers who are filing form 941, which is your employer quarterly return, and claiming an employer tax credit needs to be very careful and use a tax practitioner in that area of specialties. It could be an enrolled agent, it could be a CPA, it could be a registered tax preparer. But if you're using a payroll service company, you must be in constant communication with them, because they're not going to know that they need to file the form 7200. Or maybe you have filed, as the business owner, the form 7200. Or your accountant filed the form 7200. So here are some of the errors, common mistakes to avoid when completing form 941 and when you're also claiming these credits. So you're reporting advances requested instead of the advance payment of credits received. If the employer hasn't received the advance payment credit they requested, don't report it on the form 941, because you're going to get a balance due notice. Incorrectly reconciling the advance payment of the credit requested and received. If an employer has received the advance payment, they must reconcile it on their form 941. So first you have to receive the advance payment, reconcile it on your 941 on the lines that are listed here, line 13F, and claiming the credits on line 11B, 11C, 13C, and 13D, okay? Now, of course, using a payroll service, they're not going to know this. Form 7200 is used to request the advance payment of employer credit. It is not used to claim the credit. It's used just to request the advance payment, right? Because what's happening is employees are receiving balance due notices and then need to amend their 941. Okay, so very important slide there for you to be aware of. Now those are the credits, okay? And we talked about the employer deferral. Now there's also an employee deferral through an executive order on August 8th, 2020 that was signed by the president, that the employee can defer their Social Security. Now, there were no opt-out forms, there were no opt-in forms. You may notice some employers are not doing it. I contacted my small businesses and I said to them, if you do this, if you elect to do this, you need to have an agreement with your employee, because if your employee leaves and they're not contributing to their Social Security, it is due in the next quarter of 2021. And of course, as the employer and as it being a trust tax, you will owe those payroll tax, Social Security tax deferred by April 30th of 2021. In fact, it probably should be remitted monthly during that quarter and ratably from the employer's wages. So this needs to be handled delicately. I am doing it in one case where I have an officer employee. They are aware, they're not leaving, that they're going to have to pay ratably through their payroll the deferred Social Security taxes. And basically what this is to help to get the money in the paycheck to the employee now and then pay later. It could become a problem if the employee leaves. The employer would have to pay the deferral and then collect the money from the terminated employee, which would become difficult. In addition, again, your payroll service has to be aware of this because of the fact, and they should be if they're running the payroll, but sometimes, mistakes happen. There's a certain way of reporting this, okay? You, in fact, will have to file a W-2C to show the difference between the Social Security wages, okay? And I'm not going to go through the detail, but I provide it for you here, okay? So you need to be aware that there is not only an employer payroll tax deferral that started March 27th, but there's an employee payroll tax deferral that started August 1st. Actually, it was signed until August 8th, and then effective September 1st to December 31st. So a lot going on here. In addition, pension plan funding, the CARES Act provides single employer defined benefit pension plans more time to meet their funding obligations by delaying the due date for any contribution otherwise due during 2020 to January 1st of 2021. And that's under CARES Act Section 3608. So that's your CARES Act, that's your FFCRA Act, that's your employee retention credits, payroll tax credits, and all the acts pretty much affecting the Tax Cuts and Jobs Act with regards to the CARES Act, okay? Now we're going to talk about 2019 acts that we actually talked about last year and some additions to these acts. The Taxpayer First Act of 2019, we brought to you at the beginning of tax season last year, in December actually last year, which puts the taxpayer first in the eyes of the IRS. And so the Bill of Rights is now being promoted, and they would like you to distribute the Bill of Rights to your clients, okay? This was effective as of July 1st of 2019. It's allowing more of an efficient IRS, as well as establishing an IRS Independent Office of Appeals, okay? And this is going to help those individuals with AGI under 400,000 and entities with gross receipts of 5 million or less, okay? A better appeals, a quicker appeals process, okay? And there was a report on this that's submitted to Congress for the Taxpayer First Act. Why do I bring it up? In addition, on this previous slide, you'll notice about 5 paragraphs down, the act also requires the tracking of identity theft cases. And as you know, if you've come to my prior presentations, I'm a cybersecurity advisory services certificate holder through the AICPA. So I do presentations on safeguarding taxpayer data and what tax practitioners need to know, right? We need to have this written security plan in place by December 31st, 2020. And I provide you some publications that you could use to have this plan in place when you renew your PTINs by the end of this year. That's IRS publication 4557 and 5293. That is part of the Taxpayer First Act. So that affects us, the preparer. And in fact, they're identifying these cases, and I gave you a specific link, Identity Theft Central. When they come in and there is an identity theft, they're sourcing them, they're tracking them, and so that they can identify the perpetrator, all right? And not only the perpetrator, but the preparer. And then the client, the taxpayer, can then do their injunctive release, right? Go after that particular perpetrator. And of course, hopefully the preparer is not part of that. So I wanted to alert you that is in place and effective. In addition, the People First Initiative, IR 2020-59, which was passed March 25th of 2020 during the pandemic. The first initiative provides all these things, okay? And pretty much it's common sense, all right? First of all, they're looking to go to non-filers, right? They're looking for the non-filers. They're minimizing field collection activities because of the fact of the coronavirus, and they're limiting liens on installment agreements, especially when you have cases in 2020 where we have pandemic issues. Okay, so that's what all this goes through. But it also mentions things like existing installment agreements, new installment agreements, how the OIC is going to work. And they extended all these things, of course, to July 15th, like they extended the tax return filing date and the estimate dates, okay? So it's to help for compliance while people are dealing with the coronavirus. So what did they do specifically that would affect our clients and ourselves? Taxpayers who qualify for a short-term payment plan option may now have up to 180 days to resolve their tax liabilities instead of 120 days. And to reduce burden, certain qualified individual taxpayers who owe less than $250,000 may set up installment agreements without providing a financial statement, which is very good, because that's a lot of information that you would have had to provide, or substantiate if their monthly payment proposal is sufficient. So they don't need to provide that at this point for installment agreements who owe less than $250,000. All right. So in addition, for those individuals who only owe for 19 tax year, 2019, and who owe less than $250,000, they may qualify to set up an installment agreement without a notice of federal tax lien filed. And that's very big for people so that it doesn't affect their credit. All right, so they're trying to work. The IRS is making it easier for struggling taxpayers. They're trying to help them. However, they're not going to reduce penalties automatically. You're going to have to work for that. You're going to have to ask, and you're going to have to prove reasonable cause, all right? And of course, interest is statutory. Okay, so that was all about the extensions to July 15th, right? Taxpayer First Act of 2019, and focusing on the taxpayer. The taxpayer comes first. The Secure Act of 2019, all right? We're financial advisors that are listening on this call, and as CPAs and EAs and tax practitioners, we're familiar with some of these acts that came into play at the end of December 2019. Okay, what this act did pretty much repealed the stretch IRA, okay, for inherited IRAs. What does a stretch mean? It's based on the life of the highest beneficiary, okay? Now payout has to be done in a 10-year period, okay? We don't have a lot of time to go through this, but I just wanted you to be aware that's also in play. And also, if we work with trusts, things called conduit trusts, where it actually flows through to the beneficiary, can be affected by the Secure Act, all right? So we're going to need to revisit our estate planning with those clients or for ourselves who use conduit IRAs. Also under the Secure Act, the age at which taxpayers must begin taking required minimum distributions, if you haven't already started at age 70 and a half. Now remember, this is effective This act was 2019, so in 2020, now this is very confusing, the CARES Act suspended RMDs, okay? So if you were 70 and a half and you were gonna have an RMD, you didn't have to do the RMD. But now the Secure Act, in the meantime, had brought the age up to 72, okay? And this benefits taxpayers born after June 30th of 1949. So now, going forward, you do not have to take your RMD until you hit age 72. However, for the qualified charitable contribution, right, it's still at age, had that there, thought I had it there, still at age 70 and a half, okay? Previously, you could contribute to this, still at that 70 and a half stage, okay? And also, the Secure Act, you can contribute to an IRA up to age 70 and a half. That was what it was previously. But with the Secure Act, more people working well into their 70s and beyond, Congress revoked the age cap on IRA contributions and such, and starting in 2020, you can continue contributing as long as you have earned income. All right, very important planning that we have here. In addition, the Secure Act brought a new parent qualification of being alleviated of the 10% penalty from an IRA distribution if they took a distribution prior to age 59 and a half, subject to certain limitations for new parents. In addition, there's adoption credits, and for part-time workers may now contribute to their employer's 401k plan, provided they work 500 hours or more for 3 consecutive 12-month periods. And this would be effective pretty much in 2021, okay? And we'll talk about later making more favorable kiddie tax rates in your 2018-19 year that will require amendments. I cover that at the end. Also, as part of the Secure Act, you are now able to make changes to employee benefits and retirement plan administration by getting a credit, okay, on your new plan, on your new employer plan. So it used to be $500 for the new employer plan. Now it's $5,000. In addition, multiple employer plans are now available, MEEPs. It is my understanding now that the Staten Island Chamber of Commerce offers some information on MEEPs. You could actually contact them. And that's a plan where they pool employers together who contribute to the employer plan. Essentially, I believe you have to have a certain number of employees. I think in the literature, it says there isn't a minimum or a maximum, but certain plans can minimize it or make a maximum, let's say 5 or more employees per employer. The Secure Act also increased ERISA penalties. So from $25 a day to $250 a day. Let's say that individual who has a solo 401k, every July 1st, if her plan went over $250,000, $250 or more, she would have to file a Form 5500 to the IRS. This year was July 1st. Of course, the IRS was delayed, but as long as you had the postmark date of July 1st. If you don't, you can get charged $250 a day under the Secure Act. And also, because of the pandemic, now that businesses are closing, there is an option through the Secure Act where you have an ESOP, an employee stock ownership plan, that you can offer to your employees to start taking over your business if they want to try to do that endeavor. So there's a lot with this Secure Act. It's a great financial services tool if you're in that arena, and it's a lot to offer to the small businesses during this pandemic. In addition, there was a transportation benefit where you give your employee up to $250 where they didn't have to report for their employer paid transportation. For-profits are not allowed to deduct it under the Tax Cuts and Jobs Act, but under the Further Consolidated Appropriations Act of 2020, tax exempts can, and they're not going to be subject to that unrelated business income tax, okay? And employers may adopt employer-funded retirement plans up to the due date of the employer's tax return. That was a new part of that legislation. In addition, under the Secure Act, it also expanded the Section 529 plans, which is your college savings plans, and it allowed for an up to $10,000 lifetime limit from these plans. So if you had 3 children, you could take up to $30,000 out. And these plans now are for qualified apprenticeship program costs. They are from K through 12, and they include tuition, books, fees, and computers. This 529 is in addition to your Coverdale, your lifetime learning credits, and your American Opportunity Credit plan credits that you're allowed to take. Of course, you can't take a lifetime credit and American Opportunity Credit at the same time, but they're up to $2,500 for the American Opportunity Credit, lifetime learning credit up to $2,000. The Coverdale, not deductible, but not reportable as far as growth is concerned if used properly, and $2,000 up to that for annual contribution. Going back to the 529, at the bottom part of this slide, you're also now able to roll over funds from a 529 plan to another family member's ABLE account, okay? As well, it must be for the same beneficiary or for a member of the same family at the 529 holder, and you can roll over from a Section 529 plan to the ABLE, and it will count towards the contribution. And that's from IRS Tax Reform Tip 2018-136. And you'll notice from the bottom, you could use this ABLE account for many different types of expenses, including housing, education, transportation, health prevention, and so on. All right, you could read that at your leisure. So more planning for the Secure Act, right? The Secure Act also allows stipend payments for graduate and doctoral students as earned income for purposes of contributing to IRAs, all right? The Secure Act also was expanded with Notice 2020-68, where they clarified the fact of small employer automatic enrollment credits and up to $5,000 in getting a credit. As we said, it repealed the maximum age of traditional IRAs from 70.5 to 72, and it maintained the 70.5 for the qualified charitable distribution. If you want to roll from your IRA, if you want to contribute directly from your IRA to a qualified charity, where you would find under Publication 78, you are able to do that, okay? At age 70.5, not at age 72. We talked about the adoption credits, and that's your Secure Act in a nutshell. Lenny, do we have any questions on the Secure Act? I just want to make sure.
I'm going to look at that in 1 second. I just want to give a key word right now.
Ed?
And being that you just finished it, perfect word would be secure.
Yes, there's a lot of planning. We still have a few days left with the Secure Act.
Sorry, we talked over each other there.
Sorry, Lenny, go ahead.
Secure, SECURE. Compensation, 10% penalty. Don't
I'll
really
proceed.
think anything specifically.
All right, we'll get to the end, and when we do.
Yeah, we do have some questions though, so we definitely want to get to them.
Okay.
But go ahead.
I decided to put in here as well, to the Secure Act and to the First Initiative, the CARES Act, and all these acts that we're dealing with from 17 all the way to 20. Why not? Let's talk about the extenders, because everyone forgets about them. So in 2020, we had the extended under the Taxpayer Certainty and Disaster Tax Relief Act of 2019. And these are just certain provisions from there's a whole list. I thought that were applicable. So under Section 101, it allows for exclusion from gross income of discharge of qualified principal residence indebtedness. So that means, you know, up to $2 million, you're permitted to exclude from gross income under Form 982, this qualified or discharge of that indebtedness on your principal residence. Okay, so that might be helpful this year in 2020, still available. Treatment of mortgage insurance premiums as qualified resident interest, deductible. Also, that was retroactive in 19, so you might want to consider looking at your client's returns or your returns if you need to amend. Reduction of the medical expense deduction floor. from 10% to 7.5%. Deduction of qualified tuition and related expenses. So amongst the other plans that I just talked about, American Opportunity Credit, Lifetime Learning Credit, the 529 plans, we have also the college tuition deduction, which is up to $4,000, okay? And that is for those with AGIs that do not exceed 65,000 for single and 130,000 for joint filers. And then we have our energy credit incentives. But remember, if you took these energy credits previously and you had spent the $500 max, you're not going to get it on the 2020 return. But they're still available. They have been extended. One of the provision allows a credit of 10% of the amounts paid or incurred by the taxpayer for qualified energy improvements to the buildings, windows, doors, skylights, roofs, for the principal residence. Not for the vacation home, not for the second home, okay? And then you have your other provision, which is up to $300 for energy efficient property that include furnaces, boilers, biomass stoves, heat pumps, water heaters, central air conditioners, and central circulating fans, which are subject to certain types of provisions, okay? And you'll see that on the receipt when you purchase those equipment. Also expanded was disaster relief. But then, of course, we had the CARES Act, which helped even more with that. And as I said before, the repeal of the transportation fringe benefit, unrelated business taxable income for not-for-profits. Okay, so that's Section 302. So that's pretty much that act. This talks about mending for your prior returns. We talked about that. And also in 2020, with businesses with average annual gross receipts where you have 26 million, right? Under 26 million, last 3 previous years, you look at that. They could have implemented, even in 2018, under 25 million or 25 million and under, the small business accounting, okay? That came from the Tax Cuts and Jobs Act. And in this year, on July 29, 2020, the IRS and Treasury released an advanced copy of proposed regs in this area. And it talks about the gross receipts test and that you must be under that for the previous 3 years. Also, how to implement these procedures if you are on the accrual method so that you could go to the cash method. Now, in all of this, if you have an applicable financial statement, which we defined before, right, certified by a CPA, you will then, and usually it's a review and above, you will have to follow the accounting method in that financial statement, okay? So keep that in mind. And then I go through a dissertation to give you information on research in that area. But it's all pointing to try to get to that cash method of accounting, all right? And there's an inventory exception. The Tax Cuts and Jobs Act provided welcome simplification by permitting eligible small business taxpayers to either treat inventory as non-incidental materials and supplies, something we talked about with the tangible property regulations when you're permitted to buy up to $2,500 in small equipment and write it off as long as you have a policy in place to do that. So you can adopt this policy in your books and records as long as you don't have an applicable financial statement, go on the cash basis of accounting, and you then don't have to have an inventory calculation, especially for those businesses that are Schedule C businesses. Long-term contract exceptions under the Tax Cuts and Jobs Act. That's your percentage of completion method. So again, you have to fall under those provisions and you have an opportunity to now use the cash method of accounting. So these are accounting method changes. You should be looking at with your clients before the year ends. It might have also occurred in the prior year, so you may want to revisit that while you're amending and all these other areas. But under these new procedures, the rule prohibiting the filing of an automatic method change if the same item was changed in the past 5 years, because you're not allowed to change an item that was changed in the same 5 years, has been temporarily waived. That was one of your words, Lenny, right? Waived. So
yes, it was.
so anyway, the rules will be effective beginning on or after the date the final regulations are published in the Federal Register, the proposed rules, okay? Just to clarify this, it's already been in place, and I provide you a chart about it. So let's go to some questions. I also provide you the publication 4128. When people lose their job, what's taxable? Alan asked, is the pandemic unemployment of $600 taxable? Yes, it is. Yes, it is. It's taxable, and we're in New York State. It's taxable here as well. So you need to sit with your clients, determine for yourselves whether you need to make that last quarterly payment January 15th of 2021 and make sure that you do not get an estimated tax penalty. And as we know, job-related expenses under the Tax Cuts and Jobs Act has been suspended till 2025, unless the new administration comes in and changes it, possibly by 2021. The 2106, though, is still available for New York State, but there's an above-the-line deduction for some of these occupations, which I provided you here, such as armed force reservists, qualified performing artists, qualified fee-based state or local government officials, and employees with impairment-related work expenses. You could do an above-the-line deduction for them. Also, I want to remind you, now this wasn't part of the acts that currently, I'm going way, way back in 2015, you have the Bipartisan Budget Act, centralized partnership audit regime. Why did I bring this up? Because later I'm going to tell you about the audit campaign, all right, that IRS is now looking at with regards to partnerships. And now if you always elected no, I am not going to adopt, then you are part of the centralized partnership audit regime. And that means the partnership will get audited and not the partners, okay? Very quickly, a state and local tax issue. Please be aware that when yourself and your clients are telecommuting, if your office headquarters, let's say you're in New Jersey or you're in Massachusetts and the headquarters was normally in New York State is going to be collecting the tax on that. So again, we're in the estimated tax period, we're in the quarterly planning period, make sure, all right? AICPA is very concerned about this. The bottom of the slide, they did a survey and many workers are not aware. 71% were not aware that working remotely in other states can have an impact on the amount of state taxes owed. So this is a very important area to keep looking at. The CPA Practice Advisor did an article on it and how practitioners should be addressing it. That's the SALT. Let's go into the 2020 actions to take, because I want to get to that question of the one question on the PPP and whether you're deducting and whether you can deduct those expenses or not. 2020 actions, going back to the Secure Act, the kiddie tax have now been decoupled from the estate and trust rates for 2018 and 2019, which means you may have to amend those returns because the taxpayer may have paid too much, okay? So you wanna look at that. That's a 2020 action to take. We wanna look at our quick refunds, as we said, our net operating losses. We want to look at technical corrections, such as the qualified improvement property, that the CARES Act and how that will affect our returns and our clients' returns in 19, 20, and in 18, okay? We also want to be cognizant of the fact that the new administration looks like they're coming in, and that 0%, 15%, and 20% capital gains rates that we may have at this point, right, will change. And so we want to take advantage now of some of those rates when we make our harvesting. We want to harvest our losses and things like that. We just don't want to make just tax decisions on investments, but we want to be a smart decision maker when it comes to doing our last minute capital gain calculations and capital loss calculations. Anyone under the 12% tax rate is at 0%, okay? Anyone going up to the 35% tax rate in 2020 is at 15%, and anyone above that is at your 20% level. So please keep that in mind. In addition, if you had a capital gain in 2019, there's been an extension due to COVID, all right? This is under IR 2020-114, where you can contribute to a qualified opportunity fund. And I just read Eisner-Amper has a great list of qualified opportunity funds that you could research or your clients could look at, where that 2019 capital gain can be contributed up to December 31st, 2020. So this has been extended, and also for those qualified opportunity funds that the taxpayer sets up, there's been an extension on the amount of time you have now for that 90% test. So very important to look at. It's a few days left of December. You want to make sure, okay? because you have till December 31st, 2020 for those 2019 capital gains. So have that conversation with your clients. We talked about the coronavirus related distributions and cash flow. We talked about clients with funds in a traditional IRA, considering to convert to a Roth. Because now we have suspended our 2020 RMDs, we may be at a lower tax bracket than we were previously, correct? So we want to look at the Roth IRA conversion before the end of the year. But remember, you can't undo that conversion by October 15th like we used to do. That has been taken away. So you have a few days to make that decision to see if it's worth converting at this time. And I don't know if we have enough time, but that's something you can consider, your client can consider. And of course, the above the line $300 charitable deduction. Now let's go to that question regarding PPP and loan forgiveness, okay? What happens to a taxpayer who received a PPP loan, spent the money on ordinary business expenses, but will not have received a loan forgiveness determination prior to the date it must file its 2020 return? The taxpayer may believe that all or part of its loan will be forgiven, but ultimately its lender will review and make that determination. We told you 60 days and then another 90 days. I mean, the payments are deferred, but what do we do about the deductibility when we're doing our 2020 returns? Well, the suggestion has been, don't put your applications in yet, because if you're getting the employee retention tax credit, you can't get forgiveness. Or if you're getting forgiveness, you have to stop the deferrals. You know, things like that are in play. So you want to wait till after the December 31st, 2020, if you can, date to submit your forgiveness application. I don't even know if the banks are all ready as yet with that 3508S. And you may then need to go on extension for that small business, right? So that it will give you time to see how it will work out. Because a couple of notices have come out about this starting in April 2020, where IRS was pretty much saying, if you have received forgiveness, then you cannot deduct the related expenses that got you the forgiveness. Because of course, the loan is not taxable. So then we're not going to allow you to deduct those expenses. Now, as we approach the fourth quarter of 2020, we are in the fourth quarter, almost at the end, it appears increasingly likely that you may not be entitled, except for a few exceptions, to take deductions for business expenses paid for with the proceeds of PPP, all right? And I give you an article there for you to look at. In fact, the AICPA is challenging the IRS on this decision. When is this going to get resolved, okay? There are some notices that came out. The HEROES Act, which is still stalled, of course, wants to get rid of that provision. So there is a chance, who knows? There's something in there, we're gonna forgive all loans under 50,000 and under. So you may not even need the 3508S. It's all an unknown. But let's talk about what we do know. Notice 2020-32, non-deductible expenses in plain language. The stimulus law says, stimulus was one of your words, Lenny, right? The stimulus law says that loans forgiven under the PPP are non-taxable. Makes sense. But the legislation was originally silent on whether expenses that are funded by the PPP proceeds, such as payroll costs, utilities, and rent, are tax deductible. That was at the time of 2020-32. And then IRS answered with a bunch of explanations and examples that question in public guidance that the expenses are not deductible. Okay. And of course, there was a lot of back and forth between AICPA and other agencies with regards to this provision. And Revenue Proc 2020-51 came out as a safe harbor for claiming deductions by taxpayers that report or that have received PPP loans. And this was via KPMG. This is a report that they issued, but it goes to Rev Proc 2020-51. All right. And it provides that such a taxpayer may be able to deduct some or all of the eligible expenses. Lenny, I'm trying to fit, I know we're at the 11:30 mark, so I'm going to try to,
Let me just give the last word in case some people have to drop
go
off.
ahead. Well, we're going to try to have an the Q&A, right?
Right.
And even if we
But
go to
just in case
12,
somebody has to drop off, I want them.
okay, I just want to alert them. I don't know if we may be able to extend the credit. Okay, if we go to 12, we go to 12 and they stay on, we may be able to do that.
Okay. All right, the last word is CARES, CARES. That's CARES. Now, as
Okay.
Jane said, she's gonna wrap up. If you can stay on and we can continue, we've got some questions and whatever, and if we can, we're going to attempt to extend the credit, 2 or 3 credits, so.
Yeah, right, because we had a lot covered here. Okay, so try to stay on till 12. All right, so those are for the ones that are looking for credit. Revenue Proc 2020-51 defines a taxpayer that are eligible for the safe harbor. And it sets forth the safe harbor procedures, all right? So they created a safe harbor because everyone is confused about, can we deduct, can't we deduct? And remember, we're looking at this for tax purposes, not for financial statement purposes or accounting purposes, for tax purposes. So the first step is non-deductible, right? We think it's non-deductible if you reasonably believe that your loan is going to be forgiven, even if it was forgiven after 2020. For the first concept was, you know what, I'll wait. And then I'm on the cash basis, so I'll deduct. But no, it's the reasonable basis of believing that the PPP funds that you received are going to be forgiven by the bank. Then you shouldn't deduct, but you go on extension. All right. The taxpayers timely filed returns with extensions. 2020-51 will look at that. Original income tax return or information return. So they're going to look at all these types of returns. An amended return or administrative adjustment request. They're taking all of these in account. And the taxpayers timely filed, including extensions, original income tax return for subsequent years later that involve a denial of a PPP loan forgiveness. So we're going to look at all of this for 2020-51. And when you look at all of these facts and circumstances on your return, if you believe that you're not going to be forgiven, all right, and you should be able to deduct, you're going to put a statement as defined in 2020-51, okay, attached to your return, including that the tax may not apply the safe harbor procedures to deduct any amount of non-deductible. So if it's really truly non-deductible and you reasonably believe you're going to be forgiven, you can't use 2020-51. But 2020-51 says the IRS gives the taxpayer 3 basic choices. Claim the deductions on their tax return for 2020, if timely filed with extensions, if you reasonably believe you're going to get forgiven. You do that extension, you get forgiven, right? You don't deduct. But then if you think you're not going to get forgiven, then you can claim the deductions, all right? Claim the deductions in amended tax return for 2020 if you did not deduct them and you later were not forgiven, or claim the deductions in the tax return for the later year in which it becomes clear that the loan will be forgiven, which would be 2021, right? One of the alternative that we discussed was don't, deduct now, and if you have to, then later report the income back if you were able to be forgiven. But 2020-51 kind of gives you a step process, so you need to look at that very carefully when you're talking about non-deductibility and the reasonability of whether you're going to be forgiven or not. All right, so we go a little bit further into this slide that talks about your applicable financial statement. There's really no provisions in US GAAP talking about the PPP loan under the CARES Act, right, as a government grant. So basically, if the year ends and you put your application in, then you didn't get forgiven yet, it's going to be recognized as a debt. The loan proceeds are recorded as a debt on the balance sheet. And then any amount forgiven will be recognized in the income statement only when the loan forgiveness is granted and approved by the SBA. But remember, on audits, The IRS looks at your applicable financial statement. So keep that in mind. Okay, keep that in mind. And also loan forgiveness, and anyone who does research and development credits, those will be reduced with loan forgiveness. So I do a little spin here because we're spinning around. Our head is going crazy here with regard to this. And the AICPA has tried to provide plain English accounting in this area, and I provide you the links for that. Okay, but remember, as CPAs who are doing financial statements, you must be independent. So be very careful if you're asked to complete the PPP application or perform other management responsibilities. That is a complete no-no, okay? And so you should have legal counsel, you should be reviewing, you should be talking to your insurance carrier in these areas, and you should also go to the AICPA third-party verification toolkit in this area. Okay, that's the chart of the PPP. And also with the EIDL, keep in mind that when you're going for forgiveness and all this about non-deductibility, the EIDL, when you use the EIDL funds and they come in, you can deduct those expenses, but it can't be used for the same PPP expenses, all right? But the EIDL will be deducted from the PPP for loan forgiveness. So if someone got a $10,000 grant from the EIDL, then they will owe the $10,000 on the PPP loan. All right, so that's something to be aware of. And so I provide you provisions about closing for businesses, the different types of business, how to close businesses. And very importantly, what is the IRS looking at with regards to audits and examinations? They're looking at partnerships now, self-employment tax, the centralized audit regime I told you about, basket options, which are your structured financial transactions, virtual currency, the Tax Cuts and Jobs Act implementation in coordination with the CARES Act, micro-captive insurance and captive service providers, S-Corp built-in gains tax and S-Corp losses in excess of basis, the sale of your partnership interest. This is going to be expected to jump up by 50% in 2021. Related party transactions, qualified business income deductions under Section 199A, and conservation easement transactions, okay? More here on the link that I provide to you. So keep an eye on Washington. There's a lot going on, as we know. We have the bipartisan group of lawmakers. We have Pelosi and McConnell trying to come up with some negotiations on this PPP and some more stimulus. And we have the Biden Build Back Better tax policy that I've provided you on 3 slides. And what you need to be aware of, it really affects those whose taxable incomes are over $400,000. There's going to be a new rate, 39.6%. And there's going to be increased capital gains rate in that 39.6% rate. We're thinking maybe around the 28% area for those above $1 million. But if you're selling a property, let's say in Brooklyn or New York City, you're going to be affected by this, all right? So you need to be aware. They are increasing credits for child care credit and so on, and bringing back the first-time home buyers credit, but reducing the estate exclusion from $11.4 million to $3.5 million, okay? With possibly no step up. Business changes, we already have a corporate rate, which everyone was happy about under the Tax Cuts and Jobs Act, at a maximum of 21% for a C corporation. Well, some of my small Cs were paying 15%, so they actually were paying higher. Now it's projected under the Biden plan to go up to 28%. So be aware of that. And of course, some of the energy credits that are going to be available. And I'll let you read that at your leisure. One more reminder with regards to New Jersey corporate business tax returns. There's an automatic extension in place for 2020 CBT returns for fiscal year filers. So if your return is due January 15th, there's been an automatic extension by 6 months. If you're a fiscal year that falls into that period. All right, so I wanted you all to be aware of that. I provide you more resources. And here we are at the Q&A, Lenny.
Okay, we've got a number of questions. I'll start off with Patrick actually asked for Charlie.
Okay.
Charlie wants to know will New York State recognize rollover of IRA over the 3-year rule and regs?
Will New York State recognize that? Well,
Yep.
previously, if you remember, when we had the rollover to the Roth and we did it over the 3-year period, right now it says New York State's decoupling from the CARES Act. But I'm going to equate it to that. They accepted that provision because the income was on the return. So it looks like to me that they're going to allow the third. If
But it's
taxpayer
not
elects that.
confirmed as of yet.
What's that?
It's not confirmed as of yet.
It's not confirmed, but I will let him know once I get confirmation on that. But that's the way it was treated with the Roth conversions.
Okay. Vito asked, should taxpayers be entitled to some sort of compensation for delayed tax refunds of close to a year delay?
I'm sorry, repeat that.
He wants to know if there'd be any compensation to the taxpayer if their refund was delayed and some have been delayed.
Oh, they
Probably not.
automatically probably received, if it was after July 15th, they didn't get their refunds, they're going to receive interest. That's a very good question because IRS put an alert out there quite frequently that there's going to be a 1099 INT from the IRS because they had distributed a lot of interest payments to the taxpayers who have been delayed on their refunds.
Right.
So you're going to have to report that interest.
And I guess you're gonna have to make sure your clients give you that 1099 because
That's right.
to forget it.
That's way.
And my guess is the IRS will report it whether you get $5 or $25.
They've claimed that they probably won't be sending under $10, but they're saying that you must report the whole thing. That's their interpretation of it.
Okay. Christina asked, IRA distributions, 10% penalty waiver as a qualified COVID distribution. The person who is a member of my household, but not my dependent, is this considered for this provision as a qualified person?
Not your dependent. I'm going to have to say that that is a no because it would be part of your household, but not on your return. It could be a spouse or dependent, according to the CRD.
Okay. What's my next one here? Okay. Somebody asked, is there any chance I guess this is a thought process, that you think they'll extend the due dates for 2020?
That they haven't mentioned as yet. If you go to the AICPA and the links that I provide you in the presentation, they have a rolling chart of due dates affected by COVID. And so that will be tracked on there real time.
Okay.
AICPA. I haven't gotten any alerts on that though.
Yeah, no, nothing yet. And I don't think you're going to see anything for a while, depending on how things go.
Right.
Charlie wanted to know, is the 100,000 rollover subject to New York tax?
Did we answer that question?
I think we did.
What do you mean rollover? Rollover in the third year? Roll back, or rollover? I don't know. You mean 1/3, 1/3, 1/3 that we were talking about?
I think that's what he was talking about. Charlie, if you're looking for something different, let us know.
Okay.
Okay. And then Paul asked, are the expenses being deducted as usual to tie up payroll to the quarterly and annual forms and then the loan taken as other income, or should the expenses be actually reduced?
Is this for the PPP?
He does not state, but I'm going to make an assumption there.
So as I talked about, there's steps with the PPP loan proceeds that you receive and use for either your payroll, 60%, 100%, or if you're under the old, legislation prior to the Flexibility Act, 75%, whatever it is, and they're all qualified expenses, and you've used the funds properly through your covered period, you submit your application, it's pending, but you reasonably believe that these expenses are going to be deducted. forgiven, sorry. This loan is going to be forgiven. The expenses are going to be non-deductible. All right? You
Okay.
have to use the facts and circumstances of the case, and then use 2020-51 to determine that three-step process of, is there is a reasonable expectation that I'm going to get forgiven? Now, within the next few weeks, we may find out they're going to forgive all loans 50,000 and under the next stimulus. Then we know it's forgiven, correct? Then the expenses are not deductible because the loan proceeds are not reportable, and then in exchange, not deductible. But if there's an exception in there that they're leading to, where AICPA is asking them, you need to help the taxpayers in the pandemic, you need to help the small businesses, make it deductible, and they do make an exception, that's when you could deduct it.
Doreen, I want to add to that. If you were to file a return saying that you didn't think it was going to be forgiven, or you want to kind of ignore the fact for the moment, and let's just say you file your 2020, but in 21, your loan is ultimately forgiven. My guess is you'd have to file an amended return for 2020. Is there going to be any penalty on that because you did it the
yeah.
other way?
Yeah, because they're leading us to believe that if you reasonably believe your loan is going to be forgiven, then your expenses are non-deductible. You could go on extension and wait to find out.
Okay.
If you believe that it's not going to be forgiven, who knows? You might have had a reduction in full-time equivalents. You might have had a reduction in pay. You don't fit the safe harbors, this, that, and the other thing. Then you're able to deduct those expenses.
Okay.
And
So what's
that's
your, so what's your
2020 51, and you want to add a statement to your return because that will reduce any penalties or anything like that.
right? So you want to make it very clear if you do file a return, or if you have any thought that these loans are going to be forgiven, extend the return. Don't file it, okay? Because you could put yourself in a little bit of trouble, or your client in trouble, if you do take it and it's ultimately forgiven.
Right. Now, remember, I also brought up the applicable financial statement. So if you're a business that has which is defined as an applicable financial statement, review and above, signed off by a CPA, and you have a certain methodology, right? Many times during examination, they will use that applicable financial statement as part of the examination. So you always want to make sure everything is in conjunction with the fact pattern when you make your decision.
Okay. Is the taxpayer, Christina asked, is the taxpayer already age 73? Can he skip the RMD for 2020?
Yes, 2020 RMDs have been suspended.
Okay. And
there's no, I got to catch up in 2021. So there's none of that.
right. And then lastly, well, no, not lastly, I got more. Are expenses in excess of loan forgiveness deductible?
Are expenses in excess?
In excess of the loan forgiveness amount
Yes.
deductible?
Yes.
Okay. Cynthia asked, if you received an EIDL at 4% and refinance to a PPP at 1%, if the PPP, not PPE, I'm sorry.
Right.
If the PPP is subsequently forgiven, can you confirm that the EIDL loan is also forgiven?
Well, you refinanced it. So you would have had been in talks with the Small Business Administration, right? To get permission to do the refinancing. And so, yeah, so if you put it into the PPP, and that was the whole strategy of that, not only to reduce the interest rate, but also to use those expenses in the PPP during your covered period to try to get forgiven, right? That would have been the strategy. Some of these idle grants and loans were so significant. Like I said, I had one client who received 60 grand at one shot, just came into the bank account. And they were essential. They didn't need to use the funds. I told them, because you can't use those funds. We didn't go into detail with that, with the idle, for expansion. You can't use it for moving. You can't use it. It's very restricted. It's for the injury. Let's say you lost your inventory, then you could buy more inventory, things like that. When you refinance into the PPP, you come into a lower interest rate and you come under the PPP criteria. And so then, of course, then you would look at the loan forgiveness based on the PPP amount. But then the idle would be closed, just like you would if you did a refinancing on a mortgage, right? That mortgage would be closed out and you open up a new mortgage. Same thing.
Okay, that looks like it's it. If anybody has any other questions, please put them in now. Just to repeat a couple of things, you can contact me for any IAA information. I had put it in.
Oh,
the
yes,
chat.
let me go.
It's
I
on
have my
there?
bios back there, and this is some of our events that you had mentioned were coming up, not
Oh,
the
great.
ethics. By the way, the ethics is for just, we talked about, right, just the IRS, continuing ed, tax ethics,
Yes,
based on the instructor,
yes,
based on the instructor.
okay.
And that's in December?
December 22nd from 12 to 2.
Okay. And then we have January 21st and then February.
Yes.
Okay. And with
Okay.
that, unless we have some more questions, maybe John would like to come back, or SCORE. I want to thank you
Yeah.
all. And
Yes,
SCORE,
thank you, Doreen.
Bart,
John,
Marie, John,
Before you go
all
ahead,
of
I
us,
just wanted to,
Lenny, go ahead.
wait, we're all talking.
Sorry.
I just want to, thank John and you. Great presentation, Doreen. I've had some comments to that, and I have my own. The handouts will be forwarded, okay? Just give SCORE a chance, Doreen, to get them to them and to send them over. Everybody will get one. If you don't, let us know. The recording will be made available, and you'll be advised of that on the SCORE website. And I believe John said in the library section, you have our future meetings. As I said, my contact is liaranger@aol.com or 718-948-3008. And lastly, I want to thank everybody for being on today. We had about 75 people for most of the webinar, which is a great turnout. Hope everybody is well and safe and stay that way. And everybody have a good holiday and look forward to a much, much better new year and a happy and healthy one to all.
Thank you, Lenny. John?
Thank you, Len.
You're welcome.
I want to thank Leonard and Doreen for conducting this webinar, going through the questions, and there's an awful lot of information that was provided by Doreen. Thank you so much.
You're welcome.
It's another great year that you've put this together. As I mentioned earlier, it has been recorded and it will be available on SCORE's website. We've gone beyond the time that was originally planned. I see there's a few more questions popping up. I don't know if you want to provide an additional credit, if we have enough of hours in here to do that.
I think we're going to make it, so we're going to do our best to give the 3 credits.
Yeah, I do have a question here that says, Lenny, what do we need to do for credit? Can you just
For
explain
credit, okay, you're going to be getting a handout, okay, an evaluation form. You need to provide the keywords that I've given. You need to answer all the questions, sign the form, and return that form to me. Okay, that evaluation will come from me. The SCORE evaluation is just for their general use. That will not give you credit. The only other thing I have to add, if you have not registered for credit, but you are on for the presentation and would like credit, let me know. We will get you the information, because unfortunately, to receive the credit, you have to pay the $30 fee, and we can make
and have the numbers, the
words, right?
keywords.
And we can make the arrangements for you to get that credit. And to receive that credit, what I say, it was originally 110 minutes for 2 credits. So I guess it's 160 minutes for the 3 credits, if we could do that.
That's why we went to 12,
Yeah, that's why we.
which there was, really, it is a 3-hour course. But we were trying to condense it for time purposes and attention purposes.
And I do have another question. If a restaurant got PPP in August, 24 weeks ago, and it would end in 21, anything to do by year end?
Guess what? It doesn't end in 2021. It ends in December 31st, 2020.
Yeah.
They don't get the full covered period.
What's happening now that they're closing restaurants down again,
Yes.
basically?
So we'll see what the next stimulus provides. Hopefully, they do provide that. But what they need to do, this question, their covered period ends December 31st, 2020. And then it goes into that mode of, all right, I have to now prepare the PPP forgiveness application. And so you determine then, do I file a 3508S, which is 50,000 and under, or do I go to the next step, the next step, the next step? And with all that, they're going to ask for documentation for that period, even though it was a short covered period. All right, because they filed later, it's only to December 31st, 2020. And then we go back into that mode of, is it deductible or not?
Okay,
And by the
Look,
way, John, the handout, we were trying to attach it for people to take off the chat. But you're going to be mailing it out, right? Once I send it to you.
okay. You will get the chat, you will get the handout in a PDF format, and you will be able to go to our library on SCORE to get the video if you want to see it again. Although this sounds like it might be just for CPAs and accountants, CEs, we have on this webinar a lot of people that don't need those credits, because this is important subject matter for any business. And this is something that you could discuss with your accountant so that you're informed when you're talking with that accountant, and not feel that you don't understand what's going on.
Absolutely, John.
Yes.
Okay.
People on that don't need credits do understand. We stress the credits because our members and the CPAs and the EAs and the annual filing season people, we all need credits. Our information is open to anybody, whether you need credits, you do returns, whatever way you do them, or even if you don't do returns, you own a business. That's why we work with SCORE. And also, if you just want some personal information, okay? And in working with SCORE, we've been able to provide some of these medians through their sponsorships and whatever, which we're looking into also, you know, at no charge, as long as there's no credit involved. Also to mention, which I forgot to say, John, give a thank you to Richmond County for sponsoring, as they always do, your presentations.
Yes. Well, with that, I'd like to just wish everybody a real happy holidays, good health, and be safe. Okay, and we'll say goodbye.
Yes, thank you. Be well.
Thank you, everyone. Have a good, happy holiday.